And here we are, everybody. Happy Thursday. Big earnings we saw from Meta and Microsoft. We got Apple and the two A's, Apple and Amazon after the close today. And then we have that big jobs non-farm payrolls report tomorrow morning. How's everybody doing? Happy Friday Eve is it. That is right. One of the best eves of the week. Definitely looking forward to the upcoming weekend. MH, how you doing? All right, sup, Aladdin, sup. All right, everybody. Give us a quick smash if you can, please. Would appreciate that very, very much. As always, every day that helps out. Really surprised. I've said this in the rooms today. I'm really surprised that we are not busier right now. It's like we made these big moves, like just kind of all at once, and then we just kind of stopped. And we do have non-farm payrolls tomorrow. And again, we do have Apple and Amazon after the close today. So maybe we're going to see, more big moves. But really interesting today. We saw overnight S&Ps were up as much as 60 points. We opened the day here, and they were up, pretty much in the 50-ish range for kind of the first half hour of the day. Kind of dripped down from there, and then I don't know, by about 10 o'clock, 10:15 or so, we saw the market almost unchanged on the day. And then the only thing that I saw that I think may have caused the market to rally back with S&Ps up almost 35 again right now is, I don't know, maybe 45 minutes ago, I saw a headline that we were extending tariff deadline with Mexico. So maybe that was it. I am not really sure. And Pat, you are correct. We do have MSTR master earnings after the close today. So let's take a look at the Strangle swap. Yes, this is actually a video that you can find this on our YouTube page. You can also just find it by Googling Strangle swap. This came up earlier this year. I did a little piece for the CBOE specifically on the Strangle swap. Strangle swap. Roblox Aladdin was up monster. It was up 20% at one point this morning. It's up about 12% right now. So let's talk about Strangle swaps and something that you see, especially if you're on Thinkorswim. Okay, you're going to see when we go to place a Strangle swap in there, you're going to see something called a double diagonal. Hey, Steve, how you doing? A double diagonal. How many of you recall seeing that when you go to place your order? Okay, so the only difference between, here, let me show everybody here. Hang on one sec. Let me put something up here. Okay, so here's my Thinkorswim. And if you go right up here to the type of spread, okay, and if you hit that drop down, you're not going to see a Strangle swap. What you will see is a double diagonal. Okay, now if you hover over the double diagonal, you get another drop down that will show a double calendar. That is the same as a Strangle swap, because if you think about it, okay, if you think about a Strangle swap, what are we doing? We're buying a calendar put spread and we're buying a calendar call spread. So that is a double calendar. But if you see the double diagonal, which is very common, it's not really anything we do, but it's very common. What a double diagonal is, okay, is actually trading a straddle versus a strangle. No, Pat, our QQQ was actually a double calendar because they were the same strikes for both expirations. A double diagonal, okay, what's a diagonal, right? A diagonal is when we have two different strikes, like what we have in Reddit right now. We have a call diagonal in Reddit. Well, if we had a put side of that as well, that would be a double diagonal. So, in theory, just like calendars and diagonals are essentially the same with two different expirations, but there are same strikes on the calendars, different strikes on the diagonal. Same holds true for the double diagonal, double calendar, or what I call a strangle swap. Okay? Does that make sense, everybody? And Captain, that's all right. No, they don't mislabel it, Pat. That's what I just went through on Think or Swim. Okay, were you following along here? Okay. They do show a double diagonal. But if I click on double diagonal here, okay, a double diagonal is going to set up two different strikes with different expirations. Okay, if I set up, if I go to that, hang on one sec, let me go back to right here, that drop down, again, under double diagonal, there is another drop down which will get you to double calendar. Okay. All right. So the reason we look to do this and the reason we had the triple Q one on yesterday was not for the move that we saw early this morning, which was caused by Meta and Microsoft. It was really there to take advantage of the really, really expensive volatility that expires tomorrow. And tomorrow is really kind of the earnings day for the Qs, even though individual stocks have it right now. We were playing it off the non-farm payroll number, selling that unbelievably expensive vol on Friday and buying something cheaper just one day later on Monday. Okay. So the straddle strangle, Dave, is exactly that. So let's say we wanted to do a straddle strangle in the Qs. Okay, let's just bring the Qs in here for a second. Yesterday we had a double calendar or a strangle swap. Okay, but let's get the first. Okay, you can see if I have a double calendar populated here, all of the strikes here are the same. If I move to a double diagonal, it's going to give me different strikes. And if I go to the straddle strangle swap, what it does is you can see one set of the strikes is the same, meaning that's the straddle, versus a strangle, which are different strikes. Okay, does that make sense? Does everybody see that? Yes? Okay, great. Great. Okay, so what's the point of that straddle strangle swap or just a strangle swap, double calendar? When do I typically use it? Most of the time I use it in an earnings or a big announcement situation when we know that we have really, really pumped up vol for a reason, okay, going into an event. So we like to sell that premium and we like to buy something further out cheaper against it. So this morning we did a calendar put spread in HIMS, HIMS. Okay. If we look at what we did in HIMS, let me bring this in here. Hang on, let's get HIMS up on the board. Okay, this is what we did. Okay, out of the money put calendar. Okay, out of the money put calendar, the stock is trading, what, 70? We're using the 55 strike. Now, if we did an out of the money call calendar, maybe we would use the 80 strike or 85 strike. So if we did the exact same thing on the upside as well, that would be a strangle swap. The 55.80, selling that next week, buying the 55.80 of the following week. Does everyone understand that? So there are really two times to use a trade like this. The one we do most often is before earnings. And that's to take advantage of really low vol against something that is cheaper. Now, that being said, let me bring the QQQ position back up here, guys. Okay, this was the QQQ position that we had on that we took off this morning. All this was a calendar put spread and a calendar call spread. And optimally, ideally, where do we want stock to move at expiration of the short option? Either short strike. So you do this when you're looking for a move, but you don't really have an indication higher or lower. So you're looking for a move to either side. Okay. Now, a lot of traders don't trade around earnings, and that's fine. That's fine, because we know that volatility really, really picks up. But we also know what happens after earnings, right? We always know what happens after earnings. We have spoken about the IV crush repeatedly. Okay, so how do we know what strikes, what expirations to choose? Okay, well, just like every other situation, we look for those strike prices that are determined by the expected move. Excellent. How do we manage the leg out the expiration day of the short options? Well, we typically will close or roll that position. We will never let an in the money option get assigned to us at expiration day. We might exit the entire thing. If there's room to roll, maybe we would roll. Okay, and this is what we just talked about. Where do we want a stock to go? Either short strike. Either short strike. Now, in terms of timing and expiration, okay, typically we sell the earnings week volatility. And then we look, I usually keep it really close, okay, because we're not looking to have an investment. We're not looking to hold a position for weeks and months. So I want to look at that relationship typically between selling the earnings week volatility and buying vol either 1 or 2 weeks out. Okay? So that's why you'll notice when we do this type of trade, especially for earnings, we're looking for that immediate move and hopefully get out, roll, whatever it might be. But like I talked about, we need to understand if we are doing this type of position, we are going to see a vol crush. So, Pat, you wanted to look at Apple, right, for earnings today? Excuse me. Yeah, you know what? Before we go into that, Pat, are you still here? Just want to make sure you're here and we're going to look. Nope, crush is not the word. Crush is not the word. It's a good drink. It's not the word today. All right, Pat. So, swap is our word today. So, let's give it a minute or two. Everybody can get their entry in with the word swap. All right. So, let's go back here. Okay. Here is, and let's see if it's in the same place. I just grabbed this about a half hour ago. Apple is half a buck higher right now. Okay, so let's actually bring in the live data here for Apple. Okay, so if we were going to look at doing a strangle swap in Apple, because you looked at the charts and you're expecting to move, you don't really know which direction. Step one, what is the expected move? Stock is 209 and a half. We'll look at the 210 strike. Okay, what is the expected move in Apple for tomorrow? And we always measure that expected move going out to the short strike. So what do you guys see? Okay, 9-ish. Okay, 9.5, somewhere in that. So let's say we've got 200 and 220. Okay, and the reason I'm saying that is because those are the strikes closest to what the expected move is. Okay, that's our expected range in Apple. Okay. Okay. So the way we would look at this then is knowing what the expected move is, knowing what the expected range is, we're going to target 200 and we're going to target 220. So we would look to sell this week's 200, 220 strangle and buy either next week's or the following week's 200, 220 strangle. So let's just look at it for example purposes for next week. Okay, that would cost us approximately $1.50. Okay, we would have a 200 strike calendar put spread, a 220 strike calendar call spread. Okay, does everybody follow that? Does everybody understand that? Okay. What haven't we done yet, though? Got the expected move, so we were able to identify the strikes. What didn't we do, though? Attaboy, Jake. We have not yet accounted for our crush. We have not yet accounted for our crush, which we need to do. We know that is going to happen. So, how do we measure that again? And I don't mind reviewing this because this can be very, very difficult to understand. So, I'm bringing in now this implied volatility chart in Apple so we can all get a reference for where vol may go to afterwards. Boy, the grape, Kevin, whether it's a crush or a grape knee high, oh man, great stuff there. Great stuff. Okay, so in our estimation here, we need to change these volatilities. And hopefully, from the time we've spent reviewing IV Crush, okay, we know that we will see the impacted volatility. So the earnings week volatility typically go down by about 50%. So let's make this a 55. We'll make this a 55 also. So it's not quite 50% drop, but that's fine. Now, our long volatility, that's the one that's really, really important to hone in on. Okay, let me give you guys another look here in Apple Vol. Where do we think Apple Vol, should settle in here after earnings? I'm going to say somewhere in the mid to high 20s, 26, 27 range. Would you guys all 30s? I think that's too high. Mid 30s would be up here. That's higher than, any of this here. Dave, you agree with me? 25, 30. So I've got 26, 27 area here. And when I am adjusting my long option implied volatility, I always want to go to the lower side because I want to bake in maybe an extra crush. And if it doesn't happen, great. Okay. So let's go look now at this. We'll adjust this vol down to 26 and 26, which comes in, remember, what do we say? 40, 45% for that next week. That's pretty much right in line here. And that also, coincides to where that vol probably is going to settle in. Okay. Now I am going to have a much, much better idea of what this thing P&L wise will look like. So let me get this order back up here. Okay. Let's say it still cost us $1.50. Okay. That's not going to change what it cost us. So let's say it costs us $1.50. Okay, I'm going to run my P&L risk chart here. And all I'm going to do is put in tomorrow's expiration. Oops. Where'd you go? There you are. And what I see here, I don't like it. I see across the board here, really based on these assumptions, no chance of making money. Now, maybe I was a little too aggressive on the vols, but if I look at this and I'm comfortable with those vol adjustments, I'm not doing this. I am not doing this. Does everybody understand that? Oscar in the house. Come on, Oscar. So that is how we look at strangle swaps, guys. Strangle swaps are great positions when we don't know what direction a stock may move in, but we are looking for a move. And again, to keep things simple, what is a strangle swap? A strangle swap is nothing but a double calendar. It is a calendar put spread, a calendar call spread. Okay? All right. Let's take a look at the wheel. Mark and Paul, you may be a second or two too late. All right. What related strategies should we review to better understand? Gregory, I don't know. What do you think? If a strangle swap is just a combination of a calendar put spread and a calendar call spread, you should understand what calendars are. And you should understand, obviously, the impact of a change in implied volatility. Okay, here we go, everybody. Last one of the month. And we have got either MH or Monty. Monty, are you in the house? I think we got a new winner today. Monty Mildenberg, are you in the house? Come on, Monty, speak up. We need you. We need you. Yes, you are wonderful. Congrats. Congrats, congrats. All right, Monty, we're going to post up on the screen here. Please shoot me an email. prosperswag@prospertrading.com. There it is right there. Shoot me an email with your address, your size swag. Nicely done. All right, everybody. Again, we got the 2As, Apple, Amazon after the close today. We have got non-farm payrolls tomorrow morning, where I believe the consensus estimate is for 115,000. So that's kind of the benchmark to look at for the report tomorrow morning. Okay, not sure what just happened while we were speaking, but looks like S&Ps are back to the flat line. All right, everybody. Thank you so much. Appreciate it. Have a great Friday Eve. It is also the Major League Baseball trade deadline, so I'm sure there's going to be lots of activity if you are interested in the MLB. Thank you, Oscar. Thank you, Oscar. Appreciate that. And Oscar, you want to come by to the foundation event in Schaumburg next week? I am actually, Jeff Lake and I are doing a live Webby instructional tonight. If you guys hang on 1 second here, I will get a link. Hang on one sec. Oh, there it is. Thank you, Michael. Appreciate it. So anybody interested, tuning in 7 o'clock Central Time. Jeff Lake and I. Carlos, you see it there in the chat. Oscar, you let me know you bring your beautiful wife. And anybody that is in the Chicago area that would like to attend my charity event next week, please let me know. I would love to host you. Awesome. Awesome. All right, everybody. That's it. That's a wrap. Friday Eve. Have a great day. We'll see you tomorrow.